Hello and welcome to this session on fixed income. My name is Nidhish Singh, and I'm going to talk about the fundamentals of the fixed income security and the products. And that will be at the basic level before we start with the more advanced topics. So next, I'm going to share a PPT and will write down and explain the key terms and how it interacts with the interest rate. So as promised, this is the fixed income fundamental session. So essentially, what is the fixed income as a product? So as the name suggests, it is any financial instrument which provides us a regular cash flow during the product or at the end of the product, whereby the cash flow are fixed in some shapes, for example, the coupon rate or end of the tenure payments. Hence, this is called fixed income. Often there is a confusion that fixed income products are only bonds, which is not the fact, because any financial instrument which provides, as I explained earlier, a fixed cash flow during the tenure of the product or at the end, that will be a fixed income asset class. So as per the definition, any debt instruments such as loan paying a fixed coupon or interest percentage, that will be a fixed income product, or an equity instrument which has also a fixed dividend at regular duration, that will be also categorized as a fixed income products. So going by that example, we all know the bonds are one of the fixed income product. Similarly, there would be some exotic derivatives, means there could be some swap or interest rate options which has a fixed percent of interest at regular duration, that can also be categorized as a fixed income product. Then comes some of the asset-backed security. And what is the asset-backed security? That means when there is, say, for example, there is a loan and there are 100 such loans which has been clubbed into one single financial instrument, whereby all this bundle of loan provides the holder of ABS, a regular, say 4 or 6% of interest rate, and also at the end of the tenure, say 10 to 20 years later, the entire face value amount, if it provides, that is called an asset-backed security, because the backing of this entire financial instrument are certain assets, and those assets can be a loan or a couple of hundreds or thousands of credit card debt holders. So they will be paying a regular cash flow to the holder of this asset-backed security, and in terms of interest or coupon will be paid to the holder, and that is called fixed income product as well. So any such product which is called ABS will be part of fixed income security. Similarly, a mortgage-backed security is a variation of asset-backed security in reality, because here what happens, there would be again 1,000 or so or 100 plus some MBS holders who will be receiving a regular cash flow from a group of mortgage buyers. So as we know, in US and various European countries as well, there are a lot of mortgages which has a tenure of 20 to 30 years, and those mortgages are clubbed into one single product, and they are stripped into principal and interest based cash flow. So all these mortgages essentially are clubbed into one MBS, which will assure you 6 monthly or annual basis 4 to 6% of the interest. And those cash flow will be coming from the payment of the home buyers. So home buyer who have got who went into the mortgage with the bank will be getting the money from the home buyer, and ultimately the backed security will get the cash flow from the banks or directly from the mortgage buyers. Those cash are distributed to the MBS holders. So that also works like a typical bond. And since the mortgage cash flow are the underlying security or underlying guarantee behind this mortgage-backed security, they are given this name. So MBS is another type of fixed income product. And finally, preferred security, like preference shares, where there is a fixed dividend or a cash return guaranteed, that will be another type of fixed income products. Moving on to introduction to the typical bond and what is the history. So first of all, the first bond was issued in Mesopotamia, 2400 BC. So almost 4,400 years ago. So it's not a new product. And the history goes that those bonds were issued in terms of grains and the crops. So those who are paying some sort in terms of the barter, someone would be paying, say, goat or some animals, and in return, the loan holder will be providing them the supply of crops at a regular interval after every season. So at that point of time, the concept of bond was different. However, the overall structure was similar, that the holder of the bond will receive from the seller the crops or the grains at regular interval, just like today we receive cash flow or the coupon or interest rates. Similarly, fast forward in 1693, the first official government bond was issued by Bank of England, and in US during World War I. So around 1920 to 25, the first US Treasury bond was issued. With that history settled, we can talk about the two key components of the bonds. So for example, typically what happens in a bond scenario, a government can issue a bond for 10 years. In that duration, so each of these indicate a year, second year, third year, fourth year, and fifth year. So on and forth. So it will be like for 10 years. At the start, the government will receive from people, those who are buying the bond, say for example, $1 million. 1 million USD, and in turn, government will pay every year, say 6% of coupon. And that coupon will be paid semi-annually, which means 3% every 6 months. So 3% of coupon will be paid every 6 months. So how many installments of 3%? 10-year bond, twice a year. So there will be total 20 installment or coupons of 3% each. Okay, so that is the coupon. So that's what it is saying here. So coupon will be paid at regular interval. That will be all written in the bond, and it will be like a legal contract which will specify when the coupon will be paid, what will be the interest rate, what will be the frequency, and not only there are fixed interest on the coupon, there could be some variable interest rate as well. But for now, it is important to understand that there are coupons which can be fixed on or floating, both, and that will be generally paid on 6-monthly basis. Now, what is the principle? Going back to our example, government had issued $1 million bond. That means they received $1 million from public and are paying coupon at regular interval. However, at the end of 10 years, government needs to return that principal, and that principal amount is what we have reflected here. So the original money which was borrowed, $1 million, that will be returned back at the end of the tenure. So that is principal. So that is also called par value. So for every 100 of par value, there will be face value, and that face value will be returned at the end of the tenure. Next topic is who are the investor into the bonds, who buys them, and why they buy this. So bond is a sort of a loan. So just like we see the transactions taking place for the loan, similar thing or similar economic transaction take place in terms of the bonds. So why we invest in bond? Firstly, it is a very liquid financial instrument because they have a very good and a high frequency buy and sell in the market. If somebody want to sell for any financial reasons, they can get rid of the bond and they will get the money back. So it can be sold in the market. Market is pretty liquid. It is also having a different risk profile, and that is quite important to understand. The risk profile also influence a lot of financial decisions. For example, if somebody is investing in a stock market or in equity, they are taking on a high amount of risk because equity is paid at the very end of all in the liquidation process. So if the company is in trouble and there are shortage of cash and the market is not good, then company files the bankruptcy or goes into liquidation. So equity holders will be getting the money at last. However, the debt holder or the fixed income holder, bond holders, they will be getting money in the priority. So they are senior debt and they will be paid first. And of course, after paying off the tax and creditors, they will be paid first. However, in terms of in comparison of equity, the fixed income product holders or bond holders will be paid first. And of course, because of this, their return is also fixed. It is not a high return like equity because bondholders are going to get a fixed coupon or interest rate. So their upside potential is also limited, just like their risk profile. And it is easy to investor basically to match their liability, because if let's say someone buys a bond for 15 years and they think at the end of 15 years they might need that $1 million or say maybe 100K to finance the education of kids, or maybe for their own they need to have money after retirement for their own medical expenses, which is rising quite fast globally. So we can define our tenure of liability when we expect to have some future liability or the cash requirement. We can match those cash requirement with the maturity of the bond. So the maturity of the bond is the tenure for which bonds are bought and sold. So it is easy to kind of estimate the cash flow requirement for the future and accordingly buy the suitable bond which matches with the future liability. So these are some of the reasons to invest in bonds. Now, next we can see who are typical investor. So those who are working in the fund industry, whether alternative funds or the pension fund, insurance companies, etc., you will see a lot of buy and sell in the portfolio of the funds. So institutional investors such as central bank, maybe Fed or Bank of England or Reserve Bank of India, they will be also investing into bond for various reasons. They will earn money and the interest, plus they will be also safeguarding the value and the treasury that they have. So that could be a reason for them to hold the bonds. And it is also important for various foreign currency management perspective as well. Secondly, asset manager, as I said, there are investment manager who needs to get a decent return and also get exposure to the interest rate in various countries. So they will be buying institutional, they will be buying the bonds as the institutional investor. Next, insurance company, those who are getting the premium from you and providing the insurance product. Ultimately, they need to finance back to their client in case of any event triggers. So insurance company will be utilizing those cash which comes from the premium to invest into the bonds. Similarly, pension funds, hedge funds, and various family offices, deep pocket families also invest into the bonds for long-term to short-term based on their financial requirements. Finally, retail investors like common people, they can also invest into bonds because they are considered pretty safe in most of the cases, and they are allowed to be invested. And also private banks and the brokers can choose to invest into bonds. Moving on, bonds are, as we discussed, the loans, and there are certain issuers because we have discussed about why to invest and who invest into this, but who releases or who issues the bonds. So here are the list. National governments, any sovereign entities can issue bond, which will be trusted by their own ability to pay back and their credibility, their reputation as well. Corporates, when the corporate have very massive cash flow requirement and they have expansion plan, they can issue the bond based on those features of the coupon and the principles. They can raise money in the bond market to fund their growth. Regional governments and municipalities in US, municipality quite often raises and issue the bonds, and it will be used to finance their ambitious growth plan and some key projects that they have. So they also have a single barrel versus double barrel bonds, single barrel versus double barrel bonds, which simply means that single barrel will be financed by one project, whereas the double barrel will be financed by either the project or other cash flow of municipality. So it will just increase their level of assurance that the cash is secured, because municipality is not always, or quite often it is not supported by the federal banks or the government. So when we buy the bonds from municipalities, it is on the basis that if municipality is not able to pay for any reasons or defaults, then the money will be gone because it's not supported or guaranteed by the government. Hence, it is important to see what is the cash flow behind the bonds and where the bonds are being used and what will be the revenue stream which will be used to pay for those bonds and the coupons. And so finally, supranational agencies, for example, World Bank, Asian Development Bank, or IMF, etc., they can also issue bond and pay the coupon, or they can have bullet bonds as well. So different kind of bond can be issued by those supranational agencies as well. So these are some of the entities which can issue the bonds. So far we have understood the risk return profiles at a very high level, why to invest, who issues a bond and who invest into that as well. Now we will take a step back to understand some of the macro and microeconomic perspective as well behind the bonds. So as we discussed, bond can have, say, 10 to 20 or 30 years of tenure before it matures, which also means that if we have to wait for 30 years for any cash flow, say principal amount or continuously coupon, which will be flowing every 6 months for 30 years, means 60 installments. One question is quite natural, that are the cash flow which is coming 30 years later from now going to have the same value? And quite likely no. We are seeing the market, and there is a news of high inflation almost in every country, from developing to developed country. Everywhere inflation is common nowadays. So the money which comes in future are not of the same value. So how the investors in the bond today will be compensated? That is a key question to consider while investing in bonds. And this is why there are considerations for inflation. Also, shift in the yield curve. Now, what is yield curve? So yield curve in context of bond is when market has certain interest rate. Suppose there's an interbank borrowing and lending rates at, say, 3%, or there could be corporate lending at the rate of 5%, so on and forth. or retail rate could be even higher. It could be 6%. So there will be certain market-based yield which can grow, which can rise or reduce. So in certain cases, whenever the inflation is high, central bank will raise the interest rate, which will in turn increase the yield curve in the market, which also mean if the yield curve is rising, like this graph, there could be adverse impact on the price of the bonds. So as the yield curve or the interest rate rises in the market, the price of that bond will be impacted because bond price is inversely related to the interest rate. And also the yield. Hence, shift in the yield curve. So this yield curve can shift. It is not necessary that it will follow the same graph. If it is for, say, indicating first year, second year, third, fourth, and fifth year, this graph is at, say, timeline T, and this is, say, interest rate on the y-axis. This graph can change 3 years onward based on the expected interest rates in the future. So the graph can continue like this, and then it can either go down or it can go up. It can change the shape. So this is change in shape. Sometimes the graph can altogether move, or it can just shift. So if it was, say, for example, taking another graph, if earlier it was, the shape was like this, it can just move 2% above in the same similar shape like this as well. So first it was, say, I1, it can become I2 after the change in the interest rate by the central bank or Federal Reserve. So this is called, when there is a parallel movement in the graph of the yield curve, this is called shift in the yield curve. That also impacts the price, the value, overall return of the bonds. And final, the third key item is the default risk. Again, when we are talking about 10, 20, or 30 years of the tenure of any bond, unless this is government bond or sovereign bond, any company in the corporate or issuer can default. They can go into the financial trouble. Nowadays, we see the companies are facing a lot of uncertainty in the business after arrival of ChatGPT, a lot of AI and advanced technology and tool. It is very hard to predict which company will thrive in 2 years down the line. So there could be, if any corporate has raised the bond, issued a bond, and they face the financial difficulty, they file the bankruptcy, there could be default risk for that particular bond. So that is another one key aspect to consider about bond transactions. And finally, the FX and capital control risk as well. So a government might restrict the FX movement out of the country, or there could be some restriction on how to how much foreign currency of the can go outside the country, or we can buy. In those cases, the buy and sale of the bond can be a problem. And these are mainly central bank and regulatory activity which can restrict the buy and sale of the foreign currency denominated bonds. If it is for the same country, if it is in the same currency, that's not a problem. But if it is in foreign currency, this factor can become an issue. So there are additional risks that we must consider while investing into bonds. So this is how it looks like. We talked about the principal or face value. For $1,000, that would be face value. That means this is the amount which will be paid at the end of the tenure, at the end. This is the maturity date. So that also indicate the duration or amount of risk can rise as the maturity date is farther from the day to day. And finally, the coupon, which is paid annually. This is actually belong to old bond picture. So earlier it used to be paid annually. And why it is called coupon, and this picture shows is quite appropriately, that when the bond were issued earlier, there were some small ticket like a stamp paper, or they were like a postal stamp, and they were indicating that every time a bond, the coupon mature, the holder of the bond will be getting the coupon from the seller. Okay, so that is why this is like a demand stamp. So every time the owner of the bond will just take one stamp and will give it to the issuer and will ask for the coupon. So this is what it depicts. Now, in today's digital and advanced world, we don't need this kind of small stamps and coupon to be demanded from the issuer. However, this was the original concept, and a couple of decades back, this is how it used to be conducted. So how the bond typically is displayed on Bloomberg terminal. So name of issuer, first of all, US Treasury, and this is B class, issue date, interest accrual. So this is the date when interest accrual start, because it is matching with the issuing date. What will be the first coupon? We already discussed that every 6 months it should be paid. So you can see the 6 months difference between the interest accrual start and when it will be first paid. So first coupon date will be 6 months later. Maturity date, again, it is exactly 10 years because it is 10-year bond. This is the workout date. Security type, US coupon rate is given here, 1.75%. And since it is paid semi-annually, it will be half of this. Will be paid every 6 months. Type fixed because the rate is already fixed here. Day count is actual versus actual. We'll learn about the actual versus 30 by 360 later on, but this just says that it is actual by actual, means actual number of days will be calculated here. Currency is USD. So this is how a typical bond is displayed on the Bloomberg terminal, which you can check for any bond by putting the description. So now let's see the macro picture. What is the total bond market and what is the size of equity and bond market we are facing now? So as of 2023, there are 109 trillion worth of equity market. And just to give you some context, how much is 109 trillion? It is bigger than entire world's GDP. So the world GDP stands around $101 trillion, and equity market is bigger than that. Not only this, if we talk about the bond market, that is even much bigger than equity market. It is 127 trillion. So this is the sheer size of the bond market. If we look at together the sum of the equity and bond market, it is 236 trillion. This is really a big amount. So that is the total size of the equity and bond market. It can trade in all the major currency, 24/5 across different financial centers. 5 is the day, and 24 hours. It can trade in different exchanges in different financial centers. This is over-the-counter product as well. And finally, just to see some of the volume and the liquidity transactions. So as per 2018 bond market, the bond issued were 2.2 trillion only for the 2018 market, by the way. And equity issues were 221 billion. So this is fresh issuance. It's not the total cumulative amount. It is fresh issuance. Bond traded per day, the average was amount and the value of the bonds was 827 billion, whereas the stock trade per day, changing the hand or across the exchanges in US, was $270 billion. So that is 2018 data, and it would have certainly gone up by another 15-20% by as we talk now. Life cycle of a bond, as we discussed earlier, bonds are expected to start from par value. However, it could be at discount or at a premium. as well. So 100 par bond, when it is sold at discount, it could be 95 or 90 or 88. When it will be traded at premium, it could be 105, 108, based on various parameters. So it could be at discount or it could be at premium. However, one point to note is any bond which is whether sold at discount or premium, at the end of its tenure, it will be ending at the face value, means 100 or 1000 or 1 million. It will not be leading at the discount. And this is where during the life of the bond, say it was issued at 95, and during the life of the bond, it has to become 100, right? And this is for, say, 5 years. So 1, 2, 3, 4, and 5. So a typical structure of the bond looks like this. So it was, say, issued at discount. It is supposed to reach 100. So let's say it was issued at discount here. During the life, the difference will narrow down and it will lead to 100. So whenever the bond is issued at discount, it will still lead to face value, which is 100. And if it is issued at premium, say it is 110, it's issued at premium. So throughout the life, the price will start to go down and it will end at 100, because at the end it will settle at only 100. So it has to come down to 100 in the entire span of 5 years. Now, it may not be as perfect at this graph because there are a lot of complex model how it will work. There are amortization schedule, there are convexity, there are duration, various type of duration as well. And we need to calculate the tangent of the convexity and concavity of the bond graph. A lot of issues goes into calculating exact price of the bond at, say, 2.5 years later. If we need to calculate that, there are a lot of other model we need to also consider, but this is overall concept how the price moves during the life of the bond if it is issued at discount or premium. And as the graph suggests here, bond issuance, and then every year we pay coupon. Here assumption is that it is annual coupon, but typically it is issued at as a 6 monthly coupon bond. And finally at the maturity, coupon as well as the principal, both will be returned to the holder of the bond. And during the life, as we have displayed here, it will start with, say, par value or discount or premium, but after traversing or going through the entire life and the duration of the bond, it will end at the face value again. So we need to be mindful that ultimately any bond will end at the face value, which is, say, 100 or 1000 or 1 million, etc. Now, we also need to be cognizant of the fact that the par value may not be same during the life of the bond because of various factors we'll talk about later as well. So the price of the bond can move up or down. It can fluctuate during the life of the bond, but ultimately at the end, the face value will be achieved. So during the life cycle of the bond, we see for 5 years, there will be premium and discount, and par value will not change. Bond price will be equal to par value at the maturity and issuance. However, the bond price, which we are talking about here, this part or here, this may fluctuate based on the inflation and market yield that we talked about earlier. And the overall macroeconomic fundamentals, how the market is doing, what is the various other economic parameters, those can make the significant impact on the price of the bond as well. So this is the fundamental of fixed income product and the bond, the life cycle, inflation impact, market yield impact, etc. How the coupon and principal works, how the graph look like in case of premium and discounted bonds. So in next topic, we are going to talk about in more detail how the coupon and yield interact with each other. And I will prepare another video. Thank you so much for attending this session.